MAS Financial maintained its high quality of earnings backed by a decent growth in Q1 FY23. With bad asset issues decisively behind, pickup in economic activity and a stable funding scenario, we expect strong earnings growth in the next 2 years. The stock has underperformed Nifty in the past 3 months. It's down 10% compared to a 4% rally in Nifty 50, thereby rendering the valuation extremely attractive for a business that's generating a return on assets of around 3%. It's at a steep discount to its IPO valuation of 2017, and we feel, given the consistency and quality, the stock should find a place in your long-term portfolio. MAS Financial is present in 7 states, predominantly in Gujarat, across 4 product categories: micro-enterprise loans, SMEs, two-wheelers and commercial loans. After a steep slowdown in FY21, growth gradually started picking up from second half of FY22. Now in Q1 FY23, the overall growth in AUM was over 29% YOY, with micro-enterprise loans being the key driver, followed by SME. CV segment also grew handsomely, albeit on a small base. Disbursements continue to see strong traction as well. The company feels that its target segments are going to be the key drivers of India's economic growth, and it does not see a challenge in growing the book by 20-25% per annum over the medium term. MAS Financial has a multi-channel sourcing mix to drive growth. Now, this includes its own branches, which are being expanded aggressively and contribute close to 55% of the book. Remaining 45% is predominantly sourced from its tie-ups with smaller NBFCs. In the recent quarters, fintech partnerships as well as co-lending with banks have started contributing as well. Except for a temporary hiccup with one of its NBFC partners in the second quarter of FY21 that was fully provided for, MAS has managed asset quality picture much better than most of its peers during the pandemic. Despite following RBI's new NPA recognition norm, which will get implemented officially from October this year, the company has seen a sequential decline in gross as well as net stage 3 assets. The company has a negligible structuring book of 23.6 crores. Provision cover on stage 3 is close to 37%. In addition, MAS carries a buffer provision worth 34 crores. MAS has adequate capital and a diversified funding mix which should support its growth journey. Thanks to a better funding mix, the company saw a marginal sequential decline in its cost of funds and a sequential improvement in interest margin. Since most of its borrowings are linked to MCLR, the same would be revised with a lag effect. On the asset side, it has flexibility to reprice 70% of its books. Hence, it's guiding to stable interest margins despite rising interest rates. MAS has a housing finance subsidiary focused on affordable housing. It perceives housing as a key growth driver but was cautious on lending so far. The loan book is still very small, just around 343 crore rupees, and grew by a modest 16% YOY in the last reported quarter. Thanks to the company's decent asset quality and adequate capital, the management is confident of 25-30% growth in the book, which could be an icing on the cake for MAS Financial. With most headwinds behind and MAS confident of navigating a rising rate regime, it sees little risk to its growth and is reasonably confident of maintaining ROA in the band of 2.8 to 3.2% and ROE in 15 to 18% range in the medium term. We're projecting an earnings CAGR in the excess of 25% in the next 2 years. Investors need to know that the current price is at a 14% discount to its IPO listing price of 2017, and in the last 5 years, despite the pandemic, earnings have risen by 2.3x without much deterioration in quality. We see a steady journey for this small, high-quality NBFC and recommend that you include it in your long-term portfolio. Severe economic stress impacting growth as well as asset quality could definitely be a risk that you should keep on your radar and watch out for very closely.